Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. It's great to be back. I feel like I've taken a month off, and it's just been a couple weeks, but as always, Miles and Rob, happy to join you, and it's been a continuation of volatility, exciting volatility in our markets, not only over the month and year to date, but even the last week. Miles, why don't you recap the week?
Yeah, let's start off where we generally do over at gold. Gold week to week. Again, we look at the midweek pricing from when we record our shows on Wednesday. You're looking at gold up about 3.6%, currently sitting at around 28.62, but that is definitely not the whole story, as gold did get all the way up into around 28.90, and if I'm not mistaken, actually did break 2,900 in the futures market. So a very active week in gold. Silver not too far behind, screaming up to $32.32 at the moment, $32.32. That's a 4.8% rise, inching that gold-silver ratio back down a couple points to around 88. The other white metals, platinum and palladium, not too shabby. Platinum up about 3% to 1,008. And palladium up about 3.8%, currently to 1,015. Finally, the S&P dead flat sideways at 6,058, with a little bit of up and down that we're going to look at a little closer here in a minute. And everything on the back of the US dollar, the dollar index down about 0.25% to 107.6. But not the whole story there as well, as it almost touched 110 before making a pretty significant crash back down. So we did have quite a bit of volatility across the board this week.
Well, and that's on top of a January, right, that saw gold close out the month up 6.5%. Silver outperformed that, up 8.6%. It gets none of the attention, but that's because gold's at all-time highs. You've got platinum in January was up 8.1%. And palladium led the charge up 10.6% in January. And they're all doing better, obviously, with your weekly numbers and everything else. I mean, gold's up over 9% in 2025. Silver's up over 12% in 2025 so far. Do we expect that to continue? No. I mean, it can continue to a certain point, but
or
not
maybe
at that pace for 12 straight months.
Well, it's been relentless, especially as we hit the low at around 2590, 2600, and it has just been relentless. The futures market, the commitment of traders, they continue to stay long. They have increased their hedge. And then London is 8 weeks behind. They're emptying the vaults, sending it all to New York because of impending tariff wars. But where do we go from here? I think you're going to see gold at 3,000 before we see a decline. Looking at the Elliott wave, prognosticators had a pretty mild D wave down in December with an A wave rally that we are in now. The B wave correction could be significant, but we're going higher before we see that.
Yeah, interestingly, in that type of a situation with those Elliott wave theorists, I mean, that D wave tends to be the bigger of the two declines, but not so this time. And so, I'm anxious to see where we climb to. That Miles, you mentioned the 2,900 in the futures market. That's not the market that we operate under. We operate under more of like the LBMA and the NYMEX, and we didn't quite get there. We didn't quite get to the 2890 mark. So, Miles, you point out often that those round number resistance points are pretty common.
Yeah.
And so much like what we saw in the fall of 2024 when the futures market hit 2,800, the NYMEX didn't quite make it there, and we never saw that until this rally here, which is coinciding with 2,900 in the futures market. Maybe that's more of where the resistance is occurring. Anything to add to that as you get into these uncharted waters?
I think that people just don't like writing zeros on their trade tickets at the COMEX, right? I mean, it just seems to be the case. You never know if you want to be the first guy in history to write 3000.00. That's a ton of zeros. Hand gets tired when you're writing that trade ticket. But I think we're going to see that ticket sooner than later coming probably out of New York at some point. So there's some psychology there. There's aspects of the market that are mathematical. I would argue almost everything in the market is psychology and trend following. So we're definitely seeing the weight. And I like the fact that you bring up the difference between the two markets, because it is important to bring out from time to time that you see a segregation between, the spot price of gold and then the futures price of gold. Those things do separate from each other from time to time. And that's why Rob and I have been gandering at the COT report, the Commitment of Traders report here for the last couple of weeks, because we've been noticing this difference in the futures market climbing faster than the spot price of gold itself. So what are some of the things that tells us? Why are people buying paper gold at a faster rate than physical gold? And what do we think that's leading towards?
And why is the gold being pulled out of London back to New York to the COMEX?
Yeah, speaking of two different markets, right?
Yeah.
I mean, same market, two different warehouses in a sense, right? It's coming out of the Bank of England, who's, as you said, having a hard time meeting settlement demands, and people are concerned, is there a liquidity issue going on here? Because remember, COMEX, or COMEX as some people say, or the LBMA in London, they warehouse the gold that backs a lot of the paper, whether it be futures or ETFs. And the ETFs, we don't see a net inflow. There isn't still a bunch of Western buying of gold in like GLD. This is a concern about tariffs, first and foremost. Tariffs have never been put on gold before, but they don't know what Trump's going to do. So there is a sense of urgency. Ever since he got elected, the COMEX has spiked 75% to about $85 billion worth of gold just since the election. And that's gold that's being delivered to New York. But it's a fraction. It's less than 10% of what the Bank of England is supposed to be holding. So you, again, get into these concerns of what's really backing the paper, and all the more reason to always just own your own physical ounces with no counterparty risk, no paper promise.
Right. But sitting here in the U.S. marketplace, our phones aren't ringing off the hook with people buying gold. The orders have been coming in, so don't get me wrong. We are busy, but it's not panic buying yet.
That's right.
We've seen strong orders. The market was much stronger leading up to the election in terms of demand than it is right now.
Yeah, but the price is higher now.
True.
And I do think that matters.
It does.
Well, it really matters. And the price is higher and people take physical delivery. Why?
Because they're losing faith in the system.
There you go. Right. So, of course, the gold price is going to climb.
Mm-hmm.
Of course, you're going to want physical delivery. I personally have seen a ramp up in the last 3 weeks of clients taking product out of depository.
Yes.
You guys have too?
Yes.
Because we didn't talk about that. So
that's true.
It's, obviously an ongoing concern. When the gold price is up, that's great for the gold holder, but it's a canary in a coal mine. It's telling you that something's broken or not looking very good. And the fact that the NYMEX is bringing all that gold to the U.S., there is a premium, right?
Mm-hmm.
I guess you can sell, a gold bar in New York for a higher price than you can in London. There's a form of arbitrage, so money drives interest also. But that's, again, because when there's a demand and a pinch in supply, of course, premiums spike. But it's not happening in our market. Coin premiums aren't climbing because, like you said, the phone's not ringing off the hook. But there's much bigger money moving into the metals. It's well thought out, big money.
Big money.
And that's what we can attest to.
But we're looking at the price of a mint state 63 St. Gaudens, okay? Basically a 100-year-old rare coin certified MS63 for the same price as a gold eagle.
Yeah, for a newly minted bullion American Eagle coin.
Versus a 100-year-old double eagle. Now, granted, there's a fraction, there's like 3% less gold in a $20 gold piece than there is in an eagle. But to be at the same price for an MS63 as an eagle, Tori, I've never seen that.
Yeah, it's going to happen, right, where the premiums come back to life, but you need the West buying gold. Right now, it's still the East, and it's central banks. And nothing has changed. I saw a metric today that the average central bank has about 20% of its reserves in gold. The average investor has about 1.4% of their reserves in gold. Now, why aren't we doing what central banks do? Central banks know a heck of a lot more than we do. And so when the Western investor wakes up and realizes they need that insurance policy on their portfolio, premiums are going to spike, first of all, and then supply just literally runs out. We've seen that
We've seen
handful
that
of
a few times.
Yeah.
Yep. No
So-
more. There's no more gold in the pantry, in the vault.
And the spot price can drop and you're paying more,
Yep. We've
right? So
seen
if
that.
somebody's waiting for a pullback, it's kind of like what happened with silver. It's like, well,
Yeah.
remember?
Well,
Yeah.
you get the toilet paper pricing, right? Like the post-COVID toilet paper pricing. Well, we also had the post-COVID silver pricing.
That's
You know,
right.
you look at what happened with the silver American Eagle market. When everybody decides they want something, you find out just how little of it actually exists out there.
Well, and that's always been the false sense of security here in the United States. You know, people feel like whenever they're ready to buy, they just have to get their checkbook and the world is their oyster.
Yeah, not so.
Not
And
so.
there's, again, a lot of uncertainty is driving this. There's uncertainty with the new administration, whether it's optimistic or not. You know, there's still uncertainty is naturally kind of a pessimistic outlook because you don't know what's going to happen. So there's a flight to safety in a sense. And you're seeing that whether it's in paper or physical gold. But remember, I mean, we've talked about this almost ad nauseum with Trump. He wants a weaker dollar. That's higher gold prices. He'll print his money to make it weaker. That's higher gold prices. He wants lower rates. That's higher gold prices. Tariffs and trade wars can lead to price increases or greater inflation.
One of our own chief analysts, Morgan Lewis, at our staff meeting this week, he trotted out the word devaluation of the currency. That's a little chilling.
Well, and not only a devaluation, but a slow replacement of it, you know, as the world reserve currency. He talked a lot about that. And
Yeah.
that is a concern going forward as well, as losing that reserve currency status with the sheer number of U.S. dollars in circulation. If that were to happen and it becomes an emotional, psychological event where people just don't want the dollar, that's where you get hyperinflation, right?
Well, and people misunderstand devaluation is inflation.
That's right.
But this has come up a few times where people are like, well, devaluation is good, right? No. That means your $10,000 in the bank is now worth $5,000 or $2,000 or whatever. And it's an overnight thing.
Yeah, but you've got more money in the system, so that's got to make things better, right? I mean, don't you want to push a wheelbarrow full of money down to the grocery store?
Well, and we still have to see velocity of money pick up.
Such a good point.
Yeah, that's a really good point.
And velocity is still, miles pull up the chart because I don't want to guess, but I can tell you it's not doing great.
Well, and that's a Trump mandate. Velocity of money ramps up when GDP's ramping up,
Yep.
economic activity is accelerating, money is turning over faster. You got rate cuts. You know, the Fed didn't do it this time, but they're pricing in 2 more rate cuts. Trump wants them. All of that drives the velocity of money faster, and that's why that's such a good point.
Yeah.
Yeah, well, you look at something like the velocity of M2, it's bounced back in, obviously, April 2020. So going back to COVID, that's the lowest we've ever seen that, down at around like 1.1. We have bounced back up. We're up to about 1.4. But you look through the 90s, forget that. You look through the 50s and the 60s, the 70s, the 80s, the 90s. We had velocity at 2 to 1. We even spiked up to like 2.2 to 1 in the late 90s. And it's really been a downhill slide from 2, 2.25, all the way down to 1 to 1. So it has bounced, but you throw a dead cat hard enough against the ground.
There's the milesism of the day. Well, and that goes hand in hand with the bond market. Bonds have decreased the way that you're kind of describing the velocity of money. And again, we didn't talk about that, but now you're starting to see bonds having bounced and the yields are declining. And that's also good for gold in a sense. People are moving into a diversified portfolio. And to me, there is a chance that Trump can be successful in strengthening the bond market because it is necessary. If you're going to build global confidence in our currency and in the U.S. government's fiscal policies, the biggest indicator is going to be the bond market. And so we do know that there's a chance that the bond market could be strong. I mean, I saw a thing yesterday that said anybody that's short in the bond market, you really might want to reconsider because there is a chance that it could really strengthen and rally here on top of all the spending cuts, government constraints, The USAID, for example, being reined in that spending being pinched. And there's a lot of fundamentals going on. There's the trade, quote unquote, war. It really hasn't been a trade war. It's leverage, it's red herring, it's shots across the bow, it's negotiation. Yeah. So there hasn't been a hard tariff with Canada or Mexico, which last week that was all the calls I was getting. But you do have the bond yields. You've got the growth and inflation metric right now, where the expectation is that we will have growth, maybe not, necessarily playing out in the month of February, but certainly for the quarter, GDP should be better than the fourth quarter GDP with inflation ramping up. That's good for silver. You've got Miles talking about the U.S. dollar, the debt and spending, and then the Fed rate cuts and the commitment of traders report. All of those are exciting fundamentals for us to be witnessing these price hikes.
Well, and I think if you look back at the first giant bull market in the United States, back when I was in gold as a kid in the 70s, you had industrial expansion coupled with inflation, and the economy was really roaring. The beginning of that decade, it was really, really a slow economy. By the late 70s, early 80s, the market had really ramped up, but then also the debt, and then the crash came when Volcker ramped up interest rates to rein in inflation, but we could afford to back then. We can't do that again. So there is so much happening in the 3 weeks of this administration, people's heads are spinning.
Wow. Yeah, mine is.
Yeah.
Yep.
Yeah, I can't keep up. I do want to point out, since you brought up the bond rates, the thing I do appreciate about the bond market is I would argue that with the yields coming down, it is acting, let's say, fairly sanely. So we're looking at interest rates going from 5.5 to 4.5. So you do the math, that's an 18% decline in the interest rates. Your short-term bond yields, like the 1 year, the 2 year, are down 25% compared to that 18. But you look at like a 10 year and it's only down like 10% compared to the 18. So it's nice to see that despite, the massive interest rate rise through 2022 into 2023, tapering off in 24 and down a little bit at the end of the year, the bond rates have sort of stabilized and that market isn't quite as volatile. But the volatility has definitely shifted over to other markets like we're talking about here. I mean, the equities market is concerning, is still optimistic, but at the very least, I think we're going to see a stall here in the S&P. I mean, the S&P dead flat at 6,060. It did fail a short-term higher high and put in a slightly lower low. So we could, at the very least, see the equities market sit stagnant for a period of months. There are phenomenal alternatives to things like gold. How did Ethereum do recently? If I'm not
depends
mistaken,
on what your motivation
heavy
is
on
as an,
sarcasm
as
there,
an
Miles.
alternative. Yeah.
yeah, arguably too. I know I just made a few people grit their teeth that are also gold owners and crypto owners, so I'm not mocking you. I know Bitcoin still looks relatively healthy, but Ethereum had a 36% drop in a day. It bounced. It obviously took a pretty significant bounce up, but we're looking at significant decline over the last couple weeks and months in some of the alternative cryptos. So we're seeing rampant volatility in certain places right now.
Well, in revisiting, what it means as these bond rates are coming down, and they are coming down significantly, that's where the real money is. The bond market is at least 3 times bigger than the equity market in terms of capital, and that is reflecting confidence in the U.S. that we are righting our ship. When people are willing to hold a piece of a $37-38 trillion market in the bonds, they are confident in the direction of this nation. So hats off to them. That's real money. When you see rates dropping, people moving their money into 10-plus year treasuries, that means the big money is happy with the direction of things and maybe even hedging their risk in the equity world.
Well, the big money is going to move that money to a point where small money starts paying attention.
Yeah.
And at least in our market, when small money starts getting involved en masse, that's when you see big changes happening. And we get real busy with not a lot to do. Because when gold disappears, that means we got a lot of phone calls going out, but not a lot of stuff coming in. And circling back to what you guys were talking about a second ago, I just want to make sure the listeners hear you guys. The opportunity in the premium market right now, whether it's Silver American Eagles, whether it's St. Gaudens and Liberties, when you have a futures market that's moving in a tangible market that hasn't quite caught up yet, the speed at which that stuff shifts is significant. And it's worth touching base and looking over your portfolio and saying, hey, is there anything we should be better preparing ourselves for right now?
And don't get sticker shock. Everything is relative. In-house and out-of-house, the expectation is for gold to go north of 3,000. You guys talked on the show last week. There's this huge gap here. We could go much higher than that.
Good.
What goes up comes down, but you don't know what it comes down from. At what point does it reverse, right? So
Right.
Don't get frozen on the sidelines here. I've had people cost averaging in.
Why not?
And they've been stuck, and some of that is my fault. I'm not saying, that the clients have been unwise. I'm just saying, look, if all you do is wait because gold's at an all-time high, you're missing the whole point. Gold is significantly undervalued when adjusted for inflation with where it should be. And $4,000 gold is already baked in.
Yeah.
Like we're going to see that here in the next couple of years. So don't get afraid of $2,800 all-time highs or $2,850 or $2,900. It's okay. What do you do with gold? Buy it always and often.
Well, I guess that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, do this YouTube subscribing stuff. But better yet, why not head on over to our website? We can be found at McIlvaney.com. We're also on Twitter at ICA Gold and Facebook at McIlvaney Financial. Thanks as always for listening. And if you'd like to discuss your personal portfolio with one of the advisors here at McIlvaney Precious Metals, we can be reached at 1-800-525-9556. Hope you have a great week.